you know, if they acknowledge that this bank failure is going to lead to recession, yet hike anyway, you have to say to yourself, that's the outcome that they want. Clearly, that's a desired outcome. So I guess in that regard, the move lower midday, whenever the market started to turn around, made some sense. Yeah, the market shrugged it off. I mean, this morning, things were looking pretty good. 5% was obviously a tad better than the street was looking for, but core is still 5.6%. I don't think their job is done yet, and I think that's what the market came to realization about halfway through.
Yeah, Karen?
Well, I thought your question was a really good one because I'm thinking mild recession, I would think is a home run for the Fed. If you look at the task before them to go from zero to trying to get to something normal in the midst of an inflationary bubble and to come out with only a mild recession after this pandemic bust then boom like we've never seen.
Plus banking turmoil.
Right, I would think of that as a win. And Powell would be a hero, I think. That's not a bad outcome at all for them if they can manufacture that.
I think they were probably too nervous about spooking. If they skipped and they paused right now, that would mean to us that the banking issue was worse than we thought it was. So I think they're too nervous about that. Why are they not talking about QT? QT is happening in the background. It's 25 basis points, probably of a reaction within the market. The financial crisis is probably another 25. That's 50. They're already raising. Why on earth are they going to continue to press until something else breaks, something already broke? I think they're asleep at the switch once again.
Yeah, it's interesting, though, when that data came out this morning at 8:30, if you look at the two-year yield, what happened to it, it went from 407 to 387. I know, Guy, you talk about this all the time. I mean, that move was kind of astounding. And then equities were ripping, right, in the pre-market. And then what we saw is that yields came back up and equities came in. And I'm just, like, looking at all that bond market volatility. We've been talking about the spread between the MOVE Index and the VIX. The VIX is just pinned here at 19. Like, it's just pinned here, and it seems so odd. And now that you have the move coming in, despite what I just talked about, that intraday move that we saw in such a short period of time, I feel like we're going to get away from the Fed. We get it. They're going to maybe do 25, or maybe they're not going to at the May meeting. It doesn't really matter. They're not going to go up that meaningfully from here, okay? It really then comes to, when does that pivot out? When does the market start pricing in lower rates? But for what reason, right? Just kind of putting this whole thing together. And again, if it is the best case scenario that they have a slight recession, I think we're going to be so focused in the next few weeks on earnings and what we hear from here. I just don't think it's going to be particularly good. So to me, I think that we're going to probably get off of the Fed really soon, and then we're going to get focused on what companies are saying, what sort of visibility that they have, and what sort of consumer, degradation that we have seen with this rate move, because that's the thing that's going to take longer to work its way through the economy.
They're also, to Melissa's point, they're also factoring in, the market's factoring in 100 basis points of cuts a year from now. So they're going, and they're not, it would be great if we were just talking about this next meeting. They're talking about raising now into the summer. And then, so how fast does that cut have to really happen, the 100 basis points? That's going to spook the market, in my opinion, versus help the market.
Because things are so bad, they have to cut that
exactly
much.
That precipitous of a drop, 100 basis points that quickly.
I feel like the muscle memory of rate cuts equals good things for the market is still embedded in investors. I think that's still the reaction, the twitch that happens when we get a whiff of the Fed may pivot.
The market might believe that. I don't think the Fed officials have said that at all. I mean, 6 months ago, they were talking about whether you like it or not. I mean, again, I'm paraphrasing, but it's higher for longer. And longer means exactly that. I think they're going to get a rate to where they want it to be, and I think it's going to remain there. Unemployment in this country is 3.5%. It actually ticked lower last reading. Why were we even considering lowering rates with a historic low unemployment? It makes no sense. Nothing suggests that they should be cutting rates right now.
Unless the banking turmoil is not contained.
I never do this.
Yeah.
The banking turmoil was created by the duration risk that these bankers failed to acknowledge was created by all this, everything going on with the Federal Reserve. So that's not on the economy. That's on people to just understand duration risk. So it's on them. And the bank stress test that everybody champions, Silicon Valley Bank would have passed that bank stress test. So, that's an entirely different conversation, I think.